Hello mga ka-learners! Teacher Angel here. Today, we will learn how to prepare a balance sheet and an income statement. Preparing income statements. An income statement is a report or document which shows how much a business earned or lost during a given period of time. An income statement is also known as a profit and loss statement. In contrast to a balance sheet that records the daily status of a business, an income statement is usually done weekly or monthly. This income statement report is very important. It shows the amount of sales, cost of goods or services sold, the expenses incurred in the running or operation of business, and the profits earned for a given period. To prepare an income statement, one must learn how to compute profit and loss. You learned this in Lesson 1. An income statement must be interpreted and assessed. Like the balance sheet, it also answers questions about the business. The owner can use the income statement or report to answer the following questions. Number 1, are the goals set at the start of a business being met? Number 2, is the business making a profit? Number 3, are the sales increasing or decreasing? Number 4, is the business making more money through sales or is it losing money through operation and other expenses? Study an example of an income statement here. To be able to prepare an income or financial statement, study the meaning of the following terms. Sales is the amount of money a business makes by selling goods or services. For example, Pasing sells halo-halo. If in a month, she sold 7,600 pesos worth of halo-halo, how much are her sales for the month? If you answered 7,600 pesos, you are correct. Net sales is computed as net sales equals sales minus returns and allowances. Returns and allowances are the value of goods returned by a customer or discounts given to customer. If Pasing's returns and allowances amount to 1,500 pesos, what is her net sales for the month? Net sales equals sales minus returns and allowances equals 7,600 minus 1,500 equals 6,100 pesos. Inventory is the process of counting available goods for selling and or determining the price or value of leftover goods. Beginning inventory or the amount of goods at the start of the inventory period. An inventory is usually made weekly or monthly. For that month, Pasing began by listing the cost of all the needed ingredients to make halo-halo. She estimated that they cost 4,500 pesos. What would be the beginning inventory? That would be 4,500 pesos too. Purchases are the goods bought for additional supply. In the middle of the month, Pasing ran out of sugar. She bought 20 kilos of sugar at 30 pesos per kilo. How much would be the purchases made for that day that added to her inventory? If you answered 600 pesos, you are correct. Goods available for sale. Also called the merchandise inventory, this refers to the value of the goods available on hand at any time. This is computed as goods available for sale equals beginning inventory plus purchases. How much is Pasing's goods available for sale if her beginning inventory equals 4,500, purchases equals 600, and ending inventory equals 2,000? Selling and administrative expenses are expenses for business operations such as salaries, office supplies, and other expenses. Why should this be deducted from the gross profit on sales? The gross profit on sales only considers the actual cost of the goods sold. Aside from that, the owner has to consider other expenses such as salary or payment for the workers and cost of other materials such as paper and pen used for the business. Anita, Pasing's sister, helps her in selling halo-halo. Pasing agreed to pay her 1,000 pesos a month. She also bought pens, notebooks, and other needs to record her sales. She spent 500 pesos for that. If she has no other expenses, what would Pasing's selling and administrative expenses be? If you answered 1,500 pesos, you are correct. Number 11, net profit. This is also known as her net income. The net profit tells the owner how much they are making from the business. It is computed as gross profit on sales minus selling and administrative expenses. Compute for Pasing's net profit for that month. If you came up with 1,500, you are correct. Let's remember, a balance sheet gives the owner of a business the financial status or position of the business on a specific date. A balance sheet can answer the following questions. As of today, letter A, how much does my business own? Letter B, how much does my business owe? And letter C, what is the value of my financial interest in the business? An asset is anything of value that a business owns. Liabilities and debts are the amounts that the business owes to people or other businesses. The owner's equity is the owner's share of the business. Current assets are known as liquid assets. This is composed of cash, accounts receivable, and merchandise inventory. Fixed assets are the property of the business that cannot be readily converted to cash, like store equipment and office equipment. Current assets plus fixed assets equals total assets. Total liabilities equals accounts payable plus notes payable. Owner's equity equals owner's capital plus net profit. An income statement is a report which shows how much a business earned or lost from its operations during a given period of time. An income statement is also known as a profit and loss statement. It is usually done weekly or monthly. An income statement can answer the following questions. Letter A, are the goals set at the start of the business being met? Letter B, is the business making a profit? Letter C, are the sales increasing or decreasing? Letter D, is the business making more money through sales or is it losing money through operation and other expenses? Net sales equals sales minus returns and allowances. An inventory is the process of counting available goods for sale and determining the price or value of leftover goods. Goods available for sale equals beginning inventory plus purchases. Cost of goods sold equals beginning inventory plus purchases minus ending inventory. Gross profit on sales equals net sales minus cost of goods sold. Net profit equals gross profit on sales minus selling and administrative expenses. And that's the end of our lesson on preparing balance sheets and income statements. In the next lesson, we'll discuss preparing budgets and estimating future growth. Kaya, huwag kayong aalis mga ka-learners!